Well, it is 8 o'clock, and that's a scheduled time to begin, so we will. My name is Darrell Good, and I'm here with my colleague, John Newton, and our objective today is to talk about yesterday's USDA reports, the final production estimates, focusing on corn and soybeans, as well as the December 1 stocks estimate of those two crops, and the implications for the corn and soybean balance sheet and price prospects. As indicated on the screen, we do have our slides up, or soon will be up in PDF form, and you can access those at the address on the screen. And we also encourage you to submit questions as you have them during the presentation. We will see those questions and respond to as many as we can at the end of the formal presentation. So anytime during the session that you have a question, just type it in. I think it's intuitive on your screen how to do that. And so we're going to get started. I'm going to let John start as a way of introduction. John is the newest member of our FarmDoc team. He joined our faculty just about a year ago, not quite at this point. And he comes from Ohio State University. Ohio State, excuse me.
We deserve that after last night.
With a background in dairy policy, dairy risk management, but we're converting him to a grain analyst. And you'll have to forgive John a little bit. He may be just a little bit giddy this morning after last night's game, but we'll see if we can get through this. And I'm going to let him start by taking a look at the corn production numbers that came out of yesterday's report.
Okay. Thanks, Darrell. I appreciate it. One thing, we've just been informed that the slides are not available yet this morning, but we are working to get those up at some point, either during this webinar or later this morning. So let's go ahead and get started. Yesterday, the USDA released quite a bit of information that we've been digesting here since yesterday morning. And the first thing we notice is that we now have two back-to-back big years of corn production, 2013 and 2014. The 2014 number comes in at just over 14 billion bushels of corn. That's 2.8% higher than 2013 at 13.8 billion bushels. Now, it's important to note that the 2013 production number was revised yesterday, and it was revised down 96 million bushels. And that's going to have pretty significant implications on corn consumption, and that's what Darrell's going to get to later in the webinar. But again, we had back-to-back big crops, but the 2014 crop was actually smaller than anticipated. The 14.2 billion bushels was smaller than the USDA's November estimate, which was 14.4 billion bushels of corn. If we look back historically over the last 10 years or so of the USDA November to January corn production estimates, we see that the 2014 estimate, which is down 191 million bushels, is the second largest downward revision over the last 10 years. We had a downward revision in 2006-07 of 210 million bushels, and we see that this year down 191 million bushels. That's quite a significant revision downward from November to January. And it's also, if we think about the January USDA estimate, it's smaller than the trade guess. So the Reuters survey had an average trade guess of 14.35 billion bushels of corn for 14-15, the range of which was 14.2 at the low end to 14.6 at the high end, and the USDA's estimate of 14.21 was 133 million bushels below that trade guess. Again, if we look back historically over the last 10 years, that's the second largest downward revision that we've seen since 2006-07, when we also had a revision down of 171 million bushels of corn versus the trade estimate. And the reason why both the USDA estimate for January comes in below not only the USDA November estimate and also the trade guess is going to be yield. The corn yield for January was 171 bushels per acre for the U.S. average. And if we look at the progression over 2014 estimates, we see we started in August at 167.4 bushels per acre estimate. And as the growing season continued, we realized we were going to have a pretty significant crop. And so USDA revised that up in September to 171.7 bushels. October was 174.2. We came down in November to 173.4, and then we've come down once again to 171 bushels per acre. Again, that is a record high bushels per acre yield that we've had for the U.S. Now, we can look at some of the state highlights. We see that Illinois had 200 bushels per acre. Indiana had 188 bushels per acre. Iowa, which is number one in corn production, had 178 bushels per acre, which is lower than the Illinois 200 bushels per acre, but higher harvested acreage in Iowa led to their number one ranking in corn production. Here's a real important fact. We did observe that the Ohio State had 176 bushels per acre, and Oregon had 190 bushels per acre. So while Oregon had a higher yield than Ohio State, we do notice that the Ohio State won where it mattered, and that's going to be on the football field last night. If we compare this yield estimate in January to the November forecast from USDA, we see that USDA came down in January 2.4 bushels per acre relative to the trade expectation of 173.3 bushels per acre. Again, the January estimate is below both the November and the trade estimates for corn yield. If we look back over the last 10 years, that is the largest downward revision to corn yield that we've seen. Again, 2006-07, we saw corn yield come down 2.1 bushels per acre from the November to January estimate. And so that reduced yield for January is what's going to be the primary driver on the lower than anticipated corn production. One of the ongoing storylines this fall has been comparing the NASS and FSA planted acreage of corn. And so Darrell and I put this slide together, and it shows the NASS planted acreage, the 2014 90 million acres, 90.597 million acres for NASS, and the FSA at 86 million acres. Historically, NASS and FSA have been very close. And throughout this season, that difference we see here at 43.12 has been larger than it has been historically. And so many have anticipated that either the NASS number was going to come down or that FSA was going to come up. And we see as of the January estimates, there's still a pretty significant gap relative to the historical trend. And so Darrell and I anticipate that in the January the January FSA report to be released Thursday, we may see that the FSA acreage could come up. Darrell, do you want to provide some additional perspective on this particular slide?
Sure, John. Typically, NASS and FSA acreage numbers tend to converge with a difference of about 3 million acres, and that convergence typically occurs October and November with FSA's preliminary reports. This year, the difference, as you indicated, has remained quite large, and FSA will release their final planted acreage report on Thursday of this week, and presumably the folks at NASS have seen that report and have used that, as they always do, in tweaking their estimate of planted acres. So the fact that the difference remains at 4.3 million acres compared to FSA's December report does suggest that the final report to be released this week will show a bigger FSA number, narrowing that gap a little bit more. If it does not, I think the important message is if it does not narrow, there's going to be some lingering questions about the accuracy of the NASS estimate.
Thanks, Darrell. So the next slide we have here, we're just comparing the planted acreage and the harvested acres of corn 1996 to 2014. We see the difference for 2014 at 7.4 million acres, and that's in line with historical estimates of the difference between planted and harvested acreage of corn. We do see that we had 2 years, 2012 and 2002, and those were some dry years, so that led to an increase in the difference between planted and harvested acres of corn. Now what we're going to do next is get into the stocks estimate, and Daryl's going to continue there.
Thank you, John. The importance of the December 1 stocks estimate is really in two or three categories. One, the estimate of how much corn is still in store on December 1 gives us a reading on how much corn we actually used during the first quarter of the marketing year, September, October, and November, particularly in the feed and residual category, which is not a measured category of use, but instead is revealed with the stocks estimate. Secondly, this stocks estimate obviously gives us a reading on the supply of corn that's available for the remainder of the marketing year. And thirdly, it provides some guidance on what we might expect in terms of the magnitude of year-ending stock. So this report takes on a lot of importance. We did see the USDA estimate come in at 11.2 billion bushels. That's about 750 million bushels larger than December 1 stocks a year ago, and would be a record large inventory for this time of year. It's not surprising that so much that the inventory is large given the size of the crop we have, and also over time, since we're using more corn each year, a larger inventory is not necessarily bearish. You kind of put that in context of stocks relative to the size of the market for corn. But again, 11.2 billion on December 1 is a pretty healthy inventory of corn. As we did with the production estimates, we like to compare the USDA estimate with what the trade was guessing. And the trade estimate that we use is based on the Reuters survey, and it's the average of the analysts' guesses that they survey. And we did find that the inventory estimate was about 80 million bushels larger than the trade had anticipated in that survey. Again, compared to the last 10 years, I would characterize that as kind of a middle-of-the-road difference between actual and expected inventory. We've seen much larger surprises in both directions in the past. So on the surface, it doesn't appear that would be a major price player with not much different from expectations. As I indicated, what it does reveal, however, is how much corn was implied in the feed and residual category during the first quarter of the marketing year. Just as a quick review, the way we calculate that number and the way everybody else does is we start with September 1 stocks of corn. We add to that the production estimate and imports during the first quarter of the year. Subtract from that the December 1 stocks estimate, and that gives us a reading on total consumption of corn during the quarter. And then subtracting from that total consumption the census estimate of exports for the quarter and what we think was domestic processing use of corn based primarily on ethanol production reports. And so then any unremaining use is designated as feed and residual, and that calculation comes out at just under 2.25 billion bushels, slightly less than what we consumed in the first quarter last year. And as John indicated, we did see a revision in last year's production number by 96 million bushels, a reduction, and that did reduce the estimate of feed and residual use of corn during the first quarter last year by 96 million bushels. So we're down about 100 million bushels, but compared to what the market expected, we saw feed use a bit less because of the revision in last year's number. What we tend to like to do, or what we hope we could be able to do, is to use the feed and residual disappearance during the first quarter as an indicator of how much will be used in that category for the entire marketing year. And so what we show on this slide is the percentage of marketing year feed and residual use that has occurred in the first quarter. In a perfect world, what we would see is pretty constant percentages, so that once we saw the first quarter number, we could then project pretty carefully the consumption for the year. But in fact, what we have seen is a lot of variation there. And in the last 2 years, a pretty substantial jump in feed and residual use during the first quarter as a percentage of the entire year. 2012-13, I think that large percentage in the first quarter is more logical than what we saw last year, because in 2012 we had a really small crop, high prices, and we had to ration feed use. So as the year went on, we cut back. We didn't have any rationing issues last year, but still a surprisingly large percentage in the first quarter. For this year, when we look at the first quarter consumption and compare that to what USDA is now forecasting for the year, that would represent 42% of their projection for the year. And the question is that a reasonable expectation? And it seems to me it is, so that when we look at what USDA is projecting based on what we've done today, we would have to say that it's a pretty reasonable forecast. We also like to look at first quarter consumption relative to the trade guess. And so it's a little bit different than looking at the stocks estimate versus the trade guess, because the difference on consumption also reflects the surprises in the production number as well as the surprise in the consumption number during the first quarter. And what we see is that consumption in the first quarter for feed was about 200 million bushels less than what the trade had anticipated. And that would rank among some of the larger surprises that we've seen in the last 10 years, particularly on the negative side. However, quick to point out, and we come back to this point repeatedly, is part of that surprise is the revision that occurred in last year's production and consumption numbers. So the market was working from a baseline or a benchmark last year that was incorrect. It could not expect the market to anticipate that reduction that did occur. So if we corrected for that, then the surprise would really be maybe about 120 million bushels rather than the 217 that we see here. So the question now is, what does the corn balance sheet look like with all these revisions and new estimates that came out yesterday? This is a bit of a busy slide, but for future reference, I think is helpful. This is a corn balance sheet for last year, the 13-14 marketing year. The December USDA projection this year, the revised projections that came out yesterday, and then a change column that shows how those numbers deviated from the December forecast. And on the supply side, as John has reviewed, we did see the production number come down 191 million bushels. Total supply estimate come down 196 million bushels. USDA did not revise their export forecast, still at 1.75. I think some people question that because of the slow pace of exports we've seen to date. I think there's two countervailing arguments that offsets the slow pace to date. One is when you correct the export inspections number for the census estimates, the pace is not quite as slow as it would appear just from the weekly numbers. Through the first quarter of the year, the census numbers show that we exported 40 million bushels more corn than what the export inspections numbers indicate. Secondly, we do see fairly large export sales on the books. Unshipped sales are at a level that would support us getting to 1.75 billion bushels for the year. So if the pace doesn't pick up, we may see some revision down in that number, but I think it's probably premature to revise it down at this point. As indicated, because of the surprisingly low feed and residual use during the first quarter, USDA did lower its projection of use for the year by 100 million bushels. And again, first quarter use would represent 42% of that projection, which makes it a reasonable forecast at this point. We do expect to see livestock numbers continuing to expand and core feed demand continuing to expand. And so we're seeing feed use probably right now about 240 million bushels larger than what was fed last year. The other bit of a surprise in the USDA's balance sheet was the larger ethanol projection, raised that forecast 25 million bushels. We've had a very large crush for ethanol during the first quarter of the year, about 5% higher than last year. That rate of crush is slowing, and there is some concern that the ongoing low crude oil and gasoline prices, particularly relative to ethanol prices, may curtail some of our ethanol exports, not so much domestic consumption, but would put at risk some of our exports. And we'll have to watch carefully those weekly ethanol production numbers to make sure that we're on pace for reaching this revised number. Other processing uses, not much change there from either December or last year. Ending stocks now projected at 1.877 billion bushels. The average trade guess was about 50 million bushels higher than that, but in a relatively large range of about 370 million bushel range from high to low. That lower year-ending stocks forecast resulted in a higher average price projection. $3.65 is the midpoint of the USDA's projection, and 15 cents higher than the December forecast, considerably lower than last year and where we have been. And one of the obvious reasons for that is that we are building stocks of corn now to relatively large levels, not burdensome in my opinion, but certainly adequate, sufficient inventories that keeping prices at more modest levels. I would indicate that to date, probably through the first 4 months of the marketing year, corn prices have averaged about $3.60. In the heart of the Corn Belt right now, the spot cash price is $3.80 to $3.85, and so a $3.65 average for the year seems consistent with where we have been and where we are right now. If we maintain prices at current levels for the remainder of the marketing year, we'll be pretty close to that $3.65. Since harvest, we have seen a good rebound in cash corn prices, and we're seeing recently a fairly narrow trading range on March futures, a low of about 380, a high of about 417. My guess is we're probably going to move forward in the upper half of that trading range, with some possibility of taking out that recent high if consumption numbers continue as projected by the USDA. So I would say we may end the year slightly higher than the 365, probably in the upper half of the USDA's price range, with some possibilities of cash corn prices moving up to the $4 level. Let's turn to soybeans now and get back to the production side, and we'll let John review some of those numbers.
Thanks, Darrell. Again, if we go back and we're looking at the soybean production now, we do see that 2014 soybean production came in at 3.969 billion bushels. That's 18% higher than last year's 3.358 billion bushels. The 3.969 billion bushels represents an all-time record high for soybean production historically. Relative to the November USDA estimate, there's not much of a surprise here. The January 3.969 billion bushels is only 11 million bushels higher than the November estimate of 3.958 billion bushels. Again, this represents somewhat of a middle ground of the November to January changes historically, the 11 million bushel change. Relative to the trade guess, we are in line with where the trade thought we'd be on soybean production. We're only 13 million bushels higher than the trade guess. The trade guess came in at 3.956 billion bushels. There was a 20 million bushel range here, 3.8 or 200 million bushel range, I apologize. 3.844 billion bushels to 4.020 billion bushels was the range on the trade guess for soybean production. The driver for the increase in soybean production was found on the yield side, where we saw the USDA January yield at 47.8 bushels per acre, and that's 0.3 bushels per acre higher than the November estimate. If we look back through 2014, we saw that in August we came in at 45.4 bushels per acre estimate. It was revised up in September and October and November. And finally, again, we come in at 47.8 bushels per acre in January. The highlights from the state level, we have Illinois at 56 bushels per acre, Indiana also at 56 bushels per acre, and Iowa was at 51.5 bushels per acre. The January soybean yield estimate relative to the November, as I said in the previous slide, was only 0.3 bushels per acre higher than our November estimate. And again, that's in line with the trade guess. And if we look historically, that it's in line with our historical deviation from the November and January USDA yield estimates on soybeans. So no big surprises on soybean production. If we move forward, we do compare again the NASS and FSA numbers on soybean. The traditional difference since 2007 to 2013 has been about 1.5 million acres of soybeans different between the NASS and FSA. Again, we come in a little higher this year at about 2 million acres. It's not quite as different as what we've seen in corn, but we did want to highlight this slide as well on the soybean side. Darrell, do you have anything to add here on soybeans?
No, not really. I think, as you say, the difference between the current FSA estimates and NASS are not as large as it is on corn, and wouldn't be surprised then to see Thursday's report show FSA acreage coming up just a bit to narrow that difference, although also wouldn't be surprised if the difference is maybe near the high end of what we've experienced since 2007.
Right. So the implications here really for going forward, I mean, if we don't see the FSA numbers revised up on the corn side, then that may impact how we compare these two numbers going forward. Finally, on the production side, we do see that the difference on planted acres minus harvested for soybeans at 640 million acres, and again, that's in line with what we've seen historically. We have the axis here set pretty high to show you that soybeans, with respect to corn, the difference between planted and harvested acres is relatively small on the soybean side, but on the corn side, it averages about 7.5 million acres. So we see here every number we have is under 2 million acres of soybeans, so the difference between planted and harvested is not as strong as it is on the corn side. And then from here, we're going to continue into the soybean stocks.
Okay, we can move through this a little quicker than we did on corn. There's not quite as much information in the stocks number for soybeans since we pretty much know usage during the first quarter based on census and NOPA crush estimates. But we did see December 1 stocks of soybeans reported at about 2.5 billion bushels. That would be considerably larger than last year's inventory. Again, not surprising given the size of the crop that we had this year. And importantly, not a record inventory for this time of year. We did have bigger stocks on December 1 in 2006, and that's when we were using considerably fewer soybeans than we are in today's market. So it's a big number, but when we compare it to what the trade guess, it's actually a bit smaller than what the trade had anticipated, and near kind of the largest differences that we've seen in the last 10 years. And it's a bit surprising that the market was surprised by the stocks estimate, given that the trade was very close on its production estimate, only 13 million bushels difference, but we do see a 66 million bushel difference in the stocks estimate compared to the average trade guess. And the explanation for that is in the implied feed and residual use of soybeans during the first quarter of the year. That's calculated the same way we do it on corn, just beginning supplies minus December stocks minus known use, and that residual was 281 million bushels. I don't think there's any way the market could have anticipated disappearance that big, considerably larger than last year's record residual use during the first quarter. And the question is, what really explains such a large unexplained use of soybeans during the first quarter? And there's no direct answer to that. Some will interpret as saying, well, the soybean crop really was not as big as the USDA is estimating, and residual use was actually smaller than that. We will see this number turn negative in future quarters, as it always does. So for the year, feed and residual use will be considerably less than 281 million bushels. We've also looked historically at the size of this residual use during the first quarter and tried to correlate it to any subsequent change in the soybean production estimate, and you really find no correlation there. So on the surface, you would say the December 1 stocks number on soybeans should have been a friendly number to the market, but certainly was not received that way when taken in context of the production number and the slightly higher revision in the South American soybean crop. In terms of the change in the balance sheet, the same format as we did for corn, here focusing on the change from December to January, and what you see are very small changes. The 11 million bushel increase in the estimated size of the crop bumped up the export projection another 10 million bushels, following a 40 million bushel revision higher last month based on the ongoing pace of exports and export sales. And again, this comes in the face of a 55 million bushel increase in the estimated size of the Brazilian harvest. So this balance sheet implies that world Chinese demand for soybeans will remain very robust through the remainder of the year. Even with record high consumption, USDA is projecting an increase in ending stocks to 410 million bushels. That's a little slightly higher than the average trade guess, reflecting primarily the difference in the production estimate. USDA is forecasting the season's average price in a range of $9.45 to $10.95, with an average of $10.20, 20 cents higher than projected last month. If we look at our average to date for the U.S., we've averaged for the first 4 months about $10.30. The current market, Central Midwest, is about $10 spot price on beans. So if we persist there, $10 weighted by what's left to be marketed, the $10.20 seems to be a reasonable price. I think given the magnitude of year-ending stocks and now what appears to be a much larger South American crop, there's some question whether we can really hold soybean prices at $10 or not moving forward. We've been in a relatively narrow trading range on soybeans since November, sideways pattern. I think there's some risk that we will see soybean prices drift lower and perhaps take out the lows that we've seen since November, and maybe a bit difficult to average that 10-20 for a year. It's just hard to get around the fact that we have a bit of a surplus of soybeans, a big South American crop, and then my final comment would be that the expectation is that we could see some increase in soybean acreage here in the U.S. in 2015, particularly given the almost 2 million acre cut in winter wheat seedings that was reported yesterday. So in contrast to corn, where I think we can be firm to slightly higher in the cash market moving forward, I would see some weakness in soybean prices from here into the spring of the year. With that, we've gone over our time about 4 minutes here, but we would encourage you to ask questions if you have those. We've got some time to respond to those. And we do have just one question at this point, and the question is that this analyst has been observing historically the relationship between soybean carryout and usage, that is, stocks to use ratios, conditioned upon energy scenarios, and that analysis based on historical relationships would suggest that current soybean prices are much higher than one would expect. And so the question is, given low energy prices and the level of carryout, what's holding up bean prices? Well, I would first observe that I don't think in reality that there should be any kind of strong relationship between soybean prices, soybean stocks, and energy values. I think those are independent markets. I don't see the carryover or the conditional effect of energy prices historically on soybean prices. But having said that, I think the conclusion is the same as mine, is that given the level of carryout, why are soybean prices expected to be 10, 20, and why are they still at $10? And I think the only answer to date is just the extremely robust export demand for soybeans. We've just seen the market having to bid very aggressively to meet export commitments and to get soybeans moved through the market. And that spills over into soybean meal. The strength in soybean prices has been led by soybean meal, very strong exports, probably increasing domestic demand for soybean meal given the increase in livestock numbers. But having said that, as the pace of exports winds down and South America continues to point to a big crop, I think we will see soybean prices probably weaken back into a more normal relationship with the stocks-to-use ratio.
We have a second question here. The second question is NASS and FSA numbers. At the end, which one do you look at? I'll take a stab at it and then turn it over to Daryl. You want to look at the NASS numbers. The FSA numbers are based on farm program participation, so planted acres, farmers that participate in farm programs, and not all farmers participate in farm programs. So that's what's going to lead to the smaller planted acreage numbers in the FSA series versus the NASS series. Daryl, is that?
No, that's correct. And I think historically, the NASS acres are the ones that result in production because that represents all the acres. But historically, as John indicated, there's been a pretty consistent relationship between the two because NASS uses that FSA data in tweaking their own survey data on acreage. So it's almost by definition that those two numbers converge to a pretty fixed difference, but it's always the NASS acres that's important to the market.
Right.
We have a third question, I guess. What impact do you see from Ukraine, if any? Are they exporting more than usual? We do see fairly large exports of wheat out of the Ukraine and Russia early in the year. They're not exporting more than expected based on their size of the crop. And the real twist has been really from Russia rather than Ukraine in that Russia has added some export taxes to their exports in order to try to protect domestic supplies. So even though production has been quite large in both Ukraine and Russia, we are seeing some restrictions of exports out of Russia that's helped export demand for other countries. So not really a direct impact on the corn market, indirectly through wheat, but big exports, but not unexpected exports from that part of the world.
We have another question here. What is your opinion on ethanol production in view of the crash in gasoline price? This seems to be a hot question that everyone's asking. Daryl, what do you think?
Yeah, I think, I just alluded to this in a presentation, didn't go into a lot of detail. I mean, ethanol production will gear itself to domestic and export demand, whatever that is. And the question is, does the crash in gasoline prices put domestic ethanol demand at risk? And our answer is probably not, given the mandates that are in place, that we will see physical blending probably right up to the 10% blend wall in order to meet those mandates. But what is at risk is some portion of export demand for ethanol. Again, you think about that in categories. Canada accounts for 40 to 50% of our exports. Those are supported by biofuels mandates in Canada, so those are probably not at risk. So that puts maybe 300 to 400 million gallons of ethanol exports at risk. And so at most, maybe 100 million bushels of corn, I think, would be at risk because of the crash in gasoline prices. And that's why we said the USDA's revision upward in ethanol use of corn was a bit surprising given this outlook. And that's why the market will be monitoring those numbers very carefully. Unfortunately, there's a huge lag in the export numbers that are available in the public sector. But the market will tell us, the weekly production numbers will tell us, I think, whether that export demand is beginning to wane.
I would add, too, that some people have suggested that with cheaper gasoline prices, you would expect people to start driving more. And I'm not sure if I totally buy into that argument. I think that consumption of gasoline is probably more inelastic with respect to the price. I don't think people are making significant changes in their purchase of vehicles yet with these gasoline prices. So I don't expect additional gasoline consumption to allow additional ethanol blending. Is that something you'd agree with, Darrell?
No, right. Yeah.
Let's see.
There's kind of a related question of corn and ethanol use moving forward, other energy. I guess that means moving forward would be beyond the current marketing year. And that's where clearly there's a lot more uncertainty. Our opinion is that we will continue to deal with an RFS that may, in fact, increase the minimum requirement for biofuels production above the preliminary rulemaking for 2014. Some outside chance that the statutory RFS will be reinstated, which would mean that ethanol use for 2014 would be at 13.8, for 2015 at 14 or at 15 billion gallons. And so I think there's going to be some upward pressure on biofuels consumption and therefore production. But there's a limit to how much ethanol we can consume. So there may be a gap that's created by a higher RFS and a blend wall in the U.S. And if that happens, then we would be probably looking to biodiesel as a way to fill that gap. And so I think moving forward, you might argue that there's potentially some increased demand for vegetable oils, particularly soybean oil, for increased biodiesel production. Admittedly, a lot of moving parts there, and the sooner we can get some rulemaking from the EPA, the better on that issue.
Here's another question. We've heard some news about farmer retention. Do you think farmers have decided to sell corn now?
I guess what you would say is farmers really don't act as one. But I think what you did see and will continue to see, that as corn prices approach that $4 mark, we will see farmer selling of corn. And we've seen $4 in the processing markets, both for the food processing and ethanol processing. And when that happens, we do see a bit of a surge in farmer sales. Based on the December 1 stocks number, farmers have a lot of corn to sell. They will have to sell it at some point. And I think it's that $4 cash price that will pry quite a bit of corn out of farmers' hands.
I agree with you. Darrell, which one of these do you want to tackle?
Well, I guess the other question that's related to ethanol here is whether the 15% blends may help the blend wall. Yes, if we could expand E15, that would help. With ethanol prices higher than gasoline prices, expanding E15 is a real challenge at this point, as is E85. I mean, the economics just do not work at that level. And so it would only be expanded if the RFS is large enough that can't be met by biodiesel or from the stockpile of RINs that we have, then there might be some pressure to expand the higher blends of ethanol. But right now, that's an uphill fight because of the blending economics.
Let's see.
And looking forward to next year, do you have any comments on where November beans and December corn are priced, if their ratio is at a level to encourage corn or bean acres? Again, the price ratio is just one part of the equation that decides farmers' planting decisions. They also consider relative yields and costs of those two commodities. Mm-hmm. We've always used kind of a shorthand, a 2.5 ratio of soybeans to corn as a kind of a break-even. In fact, I suspect the break-even is probably a little lower than that. If you look at the cash prices for fall delivery for Midwest producers, I think there's still a small premium for expected returns over soybeans over corn, but that clearly has narrowed, and in my opinion may continue to narrow as we go into the planting time. So that's kind of a moving target. So if you ask if farmers were planting today, would they plant more soybeans or more corn? You would probably argue more soybeans and less corn, but they're not planting today and still have some time to make that decision. And talking to farmers, if soybean prices were to hold where they are right now, I think farmers would want to see a $4.50 cash bid for harvest delivery to encourage them to maintain or perhaps bump up corn acres just a bit. And right now we're about 50 cents below that. So I think we need to see that ratio narrow just a bit more in order to avoid a reduction in corn acres. Mm. Then if $4 corn gets farmers to sell, will prices then soften for an extended period? The correct answer to that is it depends on how much farmers sell and how stingy they get if prices then retreat below $4.
Right.
I think this early in the marketing year, you're going to see sales you see a sales blip when you get $4 cash prices, then sales dry up and wait for $4 again. So I think I do not look for sustained weakness in corn prices, but a bit of a roller coaster perhaps reflecting the rate of farmer sales. The bigger issue, as John indicated, is not what farmers decide to do, it's how fast we're using the crop. That's the big issue for corn prices. Are we tracking the USDA's forecast? Are we running higher or lower than the USDA forecast? Is really what will generate the change in corn prices going forward.
And we'll continue to see that with export numbers coming out every week, watching ethanol production. So the pace of consumption, I believe, is really what's going to drive the corn price going forward. But as Darrell indicated, it could be a roller coaster maybe through the summer until we see planting intentions in March. I think we're about out of time today. We want to thank everybody for participating. If you have any additional questions, feel free to email Darrell or myself or tweet at FarmDoc Daily, and we can answer questions there.